You might think that being able to identify the trend, when to enter and exit are the most important aspects to know how to capitalize in the crypto markets. While these are important, arguably the single most critical thing to know is how to properly manage your money and investments. At the end of this section, you'll be able to apply proper techniques to an extremely volatile market and demonstrate proper risk per trade strategies. So when it comes to managing your crypto investments, I'd like to highlight a few tips or mantras for you to think about as you move into these markets. Now, first is prepare to be wrong often. The crypto markets and any market will make even the most brilliant investor look foolish at some point. So understand that you're going to be wrong and figure out how you're going to deal with being wrong. Next, you always want to have a plan. You want to design some type of framework that gives you a maximum reward with a minimum amount of risk. Next, discipline over conviction. And what I mean by discipline over conviction is you might have conviction that the price of Bitcoin is going to go to 20,000 or 50,000 or even 100,000. However, if the price isn't following your conviction, then you need to have discipline and understand where you might be going wrong. And lastly, you need to be able to sell when you can and not when you have to. The crypto markets are extremely volatile. They offer a lot of opportunity for profit. They also offer a lot of opportunity for loss. So the key is to be able to sell, even if it's just a portion of your holdings, when the prices move up dramatically, so you don't have to sell when they plunge. Remember, crypto is a brand new asset class. It might trade like penny stocks, but it's not stocks. It might look like the Forex market, but it's not the Forex market. Let me quickly touch upon two risks to the crypto space. One, capital loss. These assets are extremely risky. They've been known to pull back 80%, 90% sometimes. So you have to understand, if you're sitting on a loss, it might make sense to get out of it and move on to the next trade. And one more risk is asset loss. And this is specifically endogenous to crypto because if you don't properly secure your private keys, you're at risk at losing your entire asset. You can't really do this in the stock market. Nobody can break into your TD Ameritrade or your E-Trade account and steal your stocks. However, in crypto, if you don't secure your private keys, you can lose your entire investment. So keep these two risks in mind when you're moving into these markets. When you're buying or selling crypto assets, there are some catalysts you might keep in mind that will drive prices up or down. Now, some of these are specific to crypto, but others happen in other asset classes as well. So the first one I want to point out is added to a larger exchange. Now, we saw in December of 2017, Bitcoin Cash was added to the Coinbase exchange, and the price of Bitcoin Cash went up 200, 300% in just a day. So there became a trade where other market participants were trying to predict what would be the next asset that's added to Coinbase. Next, corporate partnerships. And this is going to be large in the years ahead. If some of these cryptos start linking up with major corporations such as Microsoft, Google, or Amazon, this is something that can drive the price up. Now, crypto is trying to decentralize everything. So the idea that they're going to link up with corporate partnerships might raise skepticism with Bitcoin maximalists. Another catalyst is forks. What a fork is if you own the specific coin and the blockchain forks, you receive an equal amount of coin in the next fork. So if you own Bitcoin going to the Bitcoin Cash fork, let's say you had 5 Bitcoins, you receive 5 Bitcoin Cash when the protocol forked. Another catalyst, government crackdown. And we've seen over the years that governments are trying to regulate cryptocurrencies. For instance, in China, it just seems to be a cat and mouse game where the government comes, shuts down exchanges, and the price of Bitcoin sells off. And then they say, we didn't want to shut them down, or they allow for more trading, and the price goes up again. So keep an eye on regulations, especially now in the United States as the SEC and the FINRA start thinking about how they regulate these crypto assets. And lastly, FUD. Now that stands for fear, uncertainty, and doubt. And this is a general malaise that happens when the Bitcoin markets have a significant pullback. This is a tone that just seems to be in the air that doesn't allow prices to go up. So these are important catalysts to think about when you're moving into these markets. There's been a lot of talk of where crypto assets fit in a portfolio. Now, we've been told to own a blended portfolio of uncorrelated assets. You want to own some stocks, some bonds, and some commodities. So where then would crypto fit in this portfolio? Well, to be sure, we're not entirely positive that crypto is an uncorrelated asset class. I don't think there's enough data to suggest that its price doesn't specifically rely on anything just yet. The asset class is so new. But then if you decide you want to own some crypto in the portfolio, here are some questions you might want to ask yourself. The first is, how much should you invest? Now, like we saw in a previous lecture, crypto is extremely risky. Not only do you have risk of capital loss, but you have risk of asset loss as well. Someone could hack into your mobile phone, steal your private keys, and your investment is totally wiped out. So consider that when you're moving into these markets. The second question is, how should you allocate these funds? Now, I think about how I can capitalize on growth in the space, and what that means is I want to own the majors, the crypto reserves, Bitcoin, Bitcoin Cash, Litecoin, and Ethereum, but I also want to blend them with a portfolio of altcoins that are moving up. So I look at that as like a 50-50 blend to capitalize on growth of the entire space in the future. When you're thinking about how much you should invest on any crypto trade, you should consider this. There's a famous book called Market Wizards, and in an interview with a trader named Tom Bassow, he stated that he never risked more than 3% of his equity on any given trade. So think about that when you're moving to the crypto markets, where these assets can move by 10%, 20%, even 40% in a single day. Now, risk per trade strategies are a key determinant of whether you'll reach your financial objectives or ruin. And the one position strategy that I like to use is called the percent risk model. And this gives me an indication of how much equity I stand to lose if the trade goes against me. So if you buy Bitcoin at, let's say, $10,000 and you have a $9,000 stop, I'll make sure that I only invest in as much that I'll know how much percent of my equity I'll lose if I get stopped out of the trade. So that concludes our section on money management. Now you should be able to apply proper techniques to an extremely volatile crypto market, and you should also be able to demonstrate proper risk per trade strategies.